we have an exciting panel today focused on venture funding. So as an introduction, I'm Indu Navar. My background is I'm an entrepreneur. I started a company about a few years ago, and which I did from founding to exiting, and through that I did seed round and Series A, B, C, raised over $20 million. So went through different stages of financing, and also went through two downturns, 2001 and 2008. So packed a lot in one company. So since then, I've been advising and investing in companies, and also helping with M&A, mergers and acquisitions. So that's about me, but I will, what we'll do is we'll go around the panelists and have them introduce. Jayaram?
Yeah, I'm Jayaram Bhat. I'm actually have a dual role. I'm an entrepreneur. I've started a company called Squelch. It's in stealth mode, funded by Shasta Ventures. And I'm also a venture partner at Shasta Ventures, so it's one of those things. I invested in a company called SkyCure for Shasta, and before that, I was the co-founder, CEO of a company called Zenprise, which is acquired. We also raised a lot of money: A, B, C, D, E, F, F1, F2, all that stuff. And
those are not visas, by the way.
Yeah. And that company was acquired by Citrix, and before that, I was the chief marketing officer of Mercury Interactive for many years, and very long time ago, used to work with Raj Jaswa over here at Intel. So.
Hi, my name is Vera Shokina. I am a managing director for Silicon Valley Bank, where I work with international markets, mostly emerging markets like India, China, countries in Latin America, Russia, Turkey, Australia. So my job is to find the most interesting startups and VC funds and bring them to SVB platform and welcome them to Silicon Valley. Before joining Silicon Valley Bank, I was a partner with Rooney Capital. That's $200 million fund with international strategy.
My name is Nitin Pachisia. I'm one of the founding partners of Unshackled Ventures. We started Unshackled out of our experiences as immigrant entrepreneurs to help immigrants succeed faster as entrepreneurs here in the US. Ultimately, our vision is to create 100,000 American jobs by the hands of immigrant-founded companies. What we do is invest capital at pre-seed stage and augment that capital with resources that our founders need, which is support around immigration, employment, and networks. So once we invest, we take care of everything immigration and employment.
So I told you, we have a really great group of people here, and as we go deep into the conversation, I think we have a lot to cover here. So we'll do our best. Like I said, we'll leave a big part for Q&A, so if you have any questions, write it down, so we'll pass the mic along. So my first question would be, Jayaram, and Jayaram is a very good friend. I've known him for a very long time, and Jayaram always wants to do multiple things at the same time. I never thought he would actually be a VC and a startup CEO at the same time. So because people always say, you're either one side or the other. So how is your experience trying to, be on one side and the other? And also, just what would you tell the audience about, raising money, right? I mean, venture funding, financing, and how does Shasta work?
Sure. Do I have the whole hour or no?
Compress it.
So it is very interesting being both an entrepreneur and a VC. As my startup gets going, it's going to be much more difficult to spend time as a VC. But right now, I probably spend 80-20, 80% as an entrepreneur, 20% as a VC. Well, because I sit on both sides of the table, literally, it's you understand what VCs are looking for, so it was much easier for me to raise money, for example. In fact, the day my startup, we gave the final presentation to the partnership, that morning I sat on the VC side of the table to listen to from a final presentation from another company to decide whether to fund them or not. And then I had to literally walk out the door, change my hat, and come back
and tear up your presentation,
as a
redo
presentation.
it. Yeah.
So, right. So, I mean, it's a great perspective. You get tremendous amount of exposure to new ideas and new and innovative and smart entrepreneurs, and it's very. I think it makes you younger because you listen to all these young people pitching all these ideas. It's a great experience.
So when you go through that from Shasta's perspective, who are the people who will be successful as they come in, through this whole process of venture financing?
Yeah. So there are two things that we look at. One, we really look at the team, right? Is the team complete, and are the individuals obviously if they have been successful before, it helps. But even the question came up earlier, what happens? All of us started somewhere, but I think we look for their energy level, their enthusiasm, and also making sure that they are properly in the proper positions. You may have a very technical engineer type, crazy scientist as the CEO who has no clue about marketing and sales, and you say, wait a minute, this isn't going to work. So no matter how good he or she is. So we would then try to meet, if you like the idea, match them up with somebody else. The other is that that idea has to be something that is possibly very big down the road, right? It is not a $20, $30 million exit, but it is a $200, $500, $1 billion exit. So those are some of the things we look for. And we also have certain themes that we want to invest in. We look at the market, the direction of the market, and we say, okay, we should invest in mobile security, we should invest in cloud, we should invest in certain themes, and we look for companies in those themes. So.
Thank you. And as we hear, it's a very typical VC-funded company where you want to see some more of the risk taken out in terms of the team and the product. But I would throw the next question to Nitin because he does early stage where there's no code even, right? Mm-hmm. So at that place, how do you evaluate these companies? I understand yours is the first 200K check into the company, but how do you evaluate the companies?
Yeah, it's hard. And that's why there's no science behind it. So hopefully we'll not get replaced by AI because there's no science to measure this. But it comes down to looking for outliers. And how you find those outliers is a function of kind of the broader definition of that is a great team that's trying to solve a big problem in a massive market. And if they are successful, they will become the new market standard. So there's a lot of variables in that statement, and all of these pieces have to fit. Just a large market is not enough by itself. Just a great team is not enough by itself. So we actually broke it down. We got very transparent. We broke it down, wrote a blog post which entrepreneurs can read. So when they're talking to us, they know what we're looking for. And it comes down to a combination of a team, a great market, and customer discovery. So we replace traction with customer discovery, and we place a lot of value on, to Jayaram's point, have you gone out and talked to your customers? What do you know about your customers? What do you know about their needs? How they buy, what do they pay for, what do they care about? It shows in how they tell the story, because founders who've done that, who've gone through that journey, speak in their customer's language, not as a techie. Yeah. And that usually is a pretty good filter.
Great, thank you. Vera, I know that at SVB you have a big role in helping international companies help fundraise. If you can give a little bit color on how they can be successful in fundraising in the Valley, outside the Valley, and what is the method that's actually been successful?
Sure, thank you. I am just Silicon Valley Bank market share in America is about 65% market share. We basically work with 2/3 of venture capital funds and of entrepreneurs. So we're not technical, so we know and understand innovation, technology in general, but we have a large number of entrepreneurs working with us. So we also see, what works, what's not working. While I'm mostly covering international entrepreneurs who are coming from overseas to Silicon Valley and to United States, I think what I'm going to say also applies to people outside of Silicon Valley who come to Silicon Valley from other states and who are not part of this ecosystem. So I think, first of all, I think it's important to be realistic and to do a lot of research. So if you're planning to approach VCs, to Nitin's point, it's important to really understand how those VCs invest, at what stage. And if you're not fitting that profile, basically it doesn't make sense to approach them, to email them. It's just you're outside of their scope. One side. Second, if you don't have a relationship with you, or you're not being introduced to them through some type of the relationship, it's also very difficult, because people always like to invest into the people with whom they already made money in the past, or with whom they worked together in a company and they really know their merits. So if you're an outsider, it's very hard to actually raise a professional round in Silicon Valley. So it does mean that you won't be able to get there in a couple of years, but at the beginning, I think it's a lot easier to fundraise through friends and family, if you are an immigrant, through the VCs that are actually active operating in other markets like India or Latin America, because VCs there, they actually know that their best portfolio companies, they all moved to United States. So it's a lot easier to write a check for them, for the successful entrepreneur who they know was successful or very high potential in their countries. They can run this check that will give the runway for the entrepreneur who comes to Silicon Valley, gives this runway to the basically next round of capital, gives them time to find American co-founder or find the first customers, to find some traction in the United States, to get some revenues going. I think that would be a lot better if they have some capital initially, not from VCs in Silicon Valley, just because the bar is very high, but get the capital somewhere else to get them to the state where the company will be ready to fundraise in Silicon Valley.
Yeah, well, so from a traditional VC perspective, from a Shasta perspective, I can tell you that one, we generally invest on the West Coast, very rarely anywhere else. However, we do invest in companies overseas as long as their big market is in the U.S. and their CEO moves here, right? I'm on the board of a company called SkyCure. It's based in Israel. All of the engineering is in Israel. But the CEO, the VP of marketing, and the VP of sales are all based here. So, I mean, that's the model we would certainly look at.
Perfect. And Nitin, I know your focus is, visa, right? Founders who don't have permanent or they're not U.S. citizens, but trying to start companies. How do you go about, what's your method to recruit them? How does somebody from, who's in the audience approach you? I mean, what does success look like?
Yeah, so we invest all around the U.S. and we're looking at entrepreneurs who have made their way to the U.S. through the school system or the corporate system for about 95% of our investments. And so what we've done is build relationships with people who are closer to these entrepreneurs. So whether it's universities, whether it's angels and VCs in those local markets, or founders. So over the last 2 years, we have seen about 1,700 companies, personally met more than 2,000 founders, relationships with more than 40 universities, more than 500 VCs and angels, and that's kind of our evangelists. Those are the folks that refer founders to us. But that's not to say that cold emails don't work. We get plenty of our deal flow directly, founders who see that we're solving a need for them and approach us directly. And we don't shun that away. I mean, we raised our first professional investor was on a cold email. So we're not going to say no to cold emails because they work. As long as they're directed, as long as you've done your work to figure out why the investor is relevant to the entrepreneur. But our focus will continue to be on specific relationships that drive the deal flow to us.
Got it. And what you will hear is that, every venture capital has got their own philosophy of what works. So sometimes when I was on the other side too, we think, don't ever cold call, because none of the VCs will respond, right? I mean, so is when we were talking to Jayaram, yes, they get a lot of inbound inquiry, but they can't, you have to rise above the crowd, right? I mean, how do you respond? I mean, usually.
Yeah, I mean, I do look at it, but most of them are, I got one a couple of weeks ago, guy from Miami looking to raise money to buy a fish factory. So that's an example. So. No.
So, you probably respond with an introduction, right? Your method is mainly
Yeah, absolutely.
come in through the
We look
introduction.
we look for introductions from people we know, somebody we know. So if you want to raise money for a VC firm like Shasta or someone else, it's best to go to LinkedIn, look at who you know in common, and have them introduce you. I think that's the best way. And now that I know Nitin, I'm hoping they'll get a lot of introductions from companies.
You
he's
will,
with.
you will. The one thing I would say is when you generalize introductions, they serve one function, which is positive bias. So as an entrepreneur, what you're trying to do is create positive bias before you actually meet the investor that you're trying to meet. So find ways to create that positive bias about yourself. It could be through an introduction, or it could be by sending a very meaningful message, or you've been in some article that I care about because I care about cybersecurity and you were named in that. It's all about that positive bias, which is going to make someone dedicate their 30 minutes to you.
Mm-hmm. And I think this is very true what Nitin said. And I think in Silicon Valley, people really love to do good introductions. When I see a company coming from one of my regions, I remember in that case it was Russia, Prisma. I don't know if you've heard about Prisma, but Prisma was introduced to me. They needed a bank account by 3 investors in Russia on the same day, and it was December 30th. And it was like, if you get 3 introductions on the same day, you pretty much drop from your New Year preparation dinners, and you jump to, in my case, to make sure the account is open by the New Year and the investment is funded. And you also spend the New Year trying to introduce this company to the important relationships, because they value good introduction when the company is getting traction, when the founder is very strong, when there is so much buzz. It's very valuable to investors as well. But you need to communicate that image. You need to communicate this information. Sometimes founder comes and he tells me, or he can tell a lawyer, or he can tell other relationships. So you need to pitch pretty much anybody who is in the valley, because when people see the founder and they get excited about the product, literally it is a priority. You drop all the other mundane things that you do because it's so unique. You all want to be associated with success story, and people would do it. If people sit on your introduction request for 2 weeks, it means then they're not excited about your company, and you need to do a better job selling. And one thing I want to say, also I think acceleration programs are a really good way for first-time founders to significantly accelerate this timeline to the funding. I think acceleration programs, they're a lot more democratic. They have different set of resources, and pretty much anybody who went through YC 500 startups, Techstars, they all valued these relationships and mindset. They learn the speed of execution. They learn how investors are fast-paced, how quickly you need to move with pretty much anything in Silicon Valley. So I've seen a lot of success stories where founders go through this acceleration programs. It still, in most cases, doesn't give them the professional Silicon Valley round from the firm, but they get, again, $2-3 million in funding after graduating from this acceleration program. Again, to get the traction, to build up the team in the US, so funds like Shasta can look at the company at the later stage.
Thank you. Thank you. What about the timeline? How long does it take to raise a fund? I mean, what's your due diligence process? And I'll go with Jayaram first, and then we'll get Nitin to chime in.
The due diligence process can be a few weeks to much longer. I guess the shortest is usually I've seen 1 week or less, but usually it's 4 to 6 weeks. If we like the idea, like the founders, we look at we have multiple meetings with other partners. We ask for customer references. We talk to them. We do due diligence through other technical people that we know in the same space. We talk to the founders several times, really try to know them better, and move forward.
So it seems like if you have another VC who wants to fund, probably things go faster.
If there's another
Add
VC
more interest, yeah. Another way to accelerate.
Yeah, sometimes it works and sometimes it's not. And if we, often we slow down because we have some questions, right, about the founder or the idea or the market. And if somebody else is rushing to invest, we will just say, okay, we can't move it with that speed. Good luck to you. So it doesn't always work, but
Yeah.
sometimes it does.
And seems like Nitin, in your case, it's so early that you have a methodology in place on how long it takes because it's you don't have much to go.
Right,
with.
there's no data, so all you're looking at is founder characteristics. And so I would say that the time that it takes for us is to get to the point of conviction. That conviction can come in many forms, but usually for us it takes at least about 4 weeks in the earliest cycles and could be up, months until we get to a point where we're convinced to invest. The due diligence itself is a few days. I mean, we can close the deal the same day if we want to. It's a very simple process. But the reason it takes longer also, I just want to be clear, is it's not just that we're always in transaction mode. So we may meet entrepreneurs today and start building a relationship with them. They may not have even conceived an idea, or we tell them that when we meet entrepreneurs, we tell them if they are seeking investing, we tell them why we're not investing, and we're very transparent with that decision. So that gives them the opportunity to come back to us with a addressal of whatever was missing, and that as an entrepreneur, I felt that wasn't something I was getting from investors I was talking to. So my partner and I, we made a decision that we're going to be very transparent and really operate as entrepreneurs. So that often leads to a longer process because then these founders go about the cycles of addressing what was missing. But from the time we have decided to invest, maybe a couple days.
Okay, awesome. Yeah, go ahead.
Yeah, and I think I brought up this point about the speed in general. What I've seen a lot with the startups, they start fundraising and they start getting initial interest from one VC and they stop working with other VCs. So I think this is a mistake. Even if you get interest from one VC, I mean, you need to be in touch at the same time with 10, 12 people to get to successful fundraising. Because once one of the venture capitalists likes your idea, he'll be actually very aggressive and very fast. I have seen this in action when the VC really likes the idea, he actually starts putting a lot of pressure on the founding to close and take his term sheet. So if other venture capitalists, if you get to that stage, if other venture capitalists didn't go through this due diligence, or you're not moving everybody at the same time, then it's you basically don't have time to negotiate or bring anybody else to negotiate a better deal. It's just very important to, once you go to this fundraising stage, to be very aggressive and maybe sleep a lot less and follow up a lot of qualified leads that you have based on the maybe upfront initial research. So you're in a position to negotiate and kind of move VCs a little bit on your schedule rather than follow their lead. I've seen it several times.
Getting more interest is better, right? You can move that now. So what we'll do is, we'll open up the questions for audience. I mean, we can keep talking about these things, but want to make sure it's relevant. Go ahead.
Actually, a question for Nitin. Due to the kind of the more uniqueness of your business model, and this is not a political question, this is a reality based on your business model, that obviously there are some things in the work that are trying to severely limit your ability to execute on your business model. So I'm curious if you can comment on that and what your potential pivot strategy might be in relation.
Or he's raising a bigger fund to do it. So yeah, go on.
There's a lot of assumptions built into that statement that we already have to think about a pivot. So let me give you some reality. Number one, nothing has changed on the ground level. All the visas that were getting approved pre-administration are still getting approved post the change in administration. There are things in the pipeline which I don't want to comment on hypotheticals, so we'll see when they come through. But since the change in administration, we have gotten 7 visas and green cards approved. And the one important thing to recognize here is we're not boiling the ocean. We're not an Infosys that's looking to hire 10,000 H-1B holders. we're investing in 8 to 10 companies a year. So on a high note, if every single founder we invest in is on H-1B, we're looking at 20 H-1Bs, right? So this is more about quality than quantity, and we don't think any of the political wins affect the entrepreneurs' activities. What it does affect is it's created a lot more awareness about it. So our deal flow has gone up 3x since the elections, and that's an outcome of just media's much more supportive of solutions, and so we've been quoted at almost every outlet, and that's driving. It's also made people activists. So on the investor side, investors have come out in support of, we want to be a part of the solution versus whining about all the problems that are out there. So I would say at the ground level, we, just like entrepreneurs, we stay focused on what's in our control, and we keep executing. I don't expect any changes in execution.
As a venture capital group on the entire panel, what is your influence on the company? Do you work with,
Good question.
you come on the board, and do you, micro level, micromanage? I mean, individually I'm sure there are differences in style.
I think Nitin and I talked about this just before we walked in here. But each VC is different, but in general, VCs are not operating. They may have operational experience like me, but we're not trying to do the job of the CEO, right? We are board members. We'll give direction. We'll give advice when asked, and when we see that you are about to touch a fire, we'll tell you not to touch the fire, right? So those are the kind of things we do. We want to make sure that you're doing the right things, hiring the right people. We help with that. We source people. We interview people for you, for executives. But generally, we look at strategy advice and things like that. But we don't micromanage. We do give operational advice, but we don't do the work for you. So
One return question: what is the reporting back to you from a company perspective? How do we report back to the VC, to
The board meetings.
do we have to give send a report to you?
Yeah. So you have board meetings anywhere from 4 to 8 times a year. And sometimes we have phone calls and update calls in between, especially in the early stage when the CEO is new and things like that. We tend to try to keep getting updates, making sure that the things are not going south. But it's reports, board meetings, and of course financial reports once a quarter that we ask for.
Yeah, for us, we're much more of a customer service organization. So we look at ourselves as what resources can we provide to the founders that we're working with, recognizing that there's a lot of unknowns at this stage. So the way we've gone about it is built a really strong community of more than 500 investors, entrepreneurs, and executives who selectively work hands-on with our portfolio founders as they need help. So if you're working on your go-to-market strategy, we'll pull 3, 4, 5 people who are in your domain and know go-to-market strategies really, really well. If you're working on a large deal with an enterprise, we'll put some of the executives from largest companies who've closed biggest deals in their verticals to work alongside you, get on phone calls with these customers and run the process for you. So it totally depends on what the team needs. At our stage, we stay much more aligned with our portfolio founders because things change almost on a weekly basis. We don't wait for board meetings and such. And so it's much more informal, but we are a part of the team, and we are a resource that you call on when you need help.
And also, it's not a one-way street. It's a partnership. So once the CEO raises money. I mean, I had a situation in Series C. After we closed the financing, the new board member said, "Hey, here is how you have to run your staff meeting, and can I come and sit in your staff meeting?" And I did allow him for the first time, and then he started giving me all these things about I have to do, and I took him out for lunch, and I said, I thank you, but no thank you, not required. We all have different styles. So it's okay. I mean, it's a partnership. You kind of have to draw the boundary like how we do with lot of things in our life. So
Yeah,
it's very important to.
I would never
Make
do
sure-
that, but
Well, if an investor is having to micromanage, chances are they've made a bad investing decision
Yeah,
in the first
exactly.
place. So
oh, they need a new CEO.
Yeah.
But,
they're trying to correct their bad decision.
But so yeah, one comment I'll make is that as your board member is your boss, but he or she is not your boss, right?
Yeah.
Is a board member. They're not your friend. You don't always or don't necessarily bounce ideas off of your board member. You're looking. You have to tell the board what you are going to do, as opposed to asking them, what should I do? So those are some of the things I would suggest. And one of the things I learned as a CEO, first-time CEO myself, and I was a first-time CEO, is that even though I had a lot of experience in the market, I needed a coach, and I hired a CEO coach that was really, really, really useful for me personally. And I know a lot of other CEOs who do this too.
Yeah. One way that I got my board engaged was customer deals references, right? When we knew we were going to close the deal, the customer really wants to talk about viability of the company, and I would have one of the board members actually talk to them. So it served two purposes. Board is involved, they're excited because they got to talk to a customer. Customer is excited because they see, so there is, so you can come up with ways to keep them engaged so they're not,
Yes, so what is the highest number of partners you've seen in a startup?
Partners as in founders?
As a founding partners, what's the highest number you've seen?
Founders.
Founders, yeah.
Highest number, I would say 3.
Okay, so, well, we're twice the size. That was, and then usually, as into your experience going through various series of investments over a long period of time, do all of those founding partners, founders
No,
stay,
it never
or-
happens. It's even with 2, it falls apart. So, and anybody who's built companies will tell you that, we're human beings. I mean, some will stick, some won't. And there's some founders who go about doing multiple companies afterwards, but that's very rare. No, they don't stick.
An interesting approach, Y Combinator. They actually look a lot at the founders' composition of the team, a lot more than at the industry or at the product. So they really like the strong team of 3 or 4 founders, all with approximately equal percentages of the company, and they want 2 or 3 of those founders be technical. So at least that's what I've heard from the partner Y Combinator, and I think it's relevant at early stage.
I think they're trying to reduce the risk. I think it's an incubator, talking about Y Combinator, because they want to make sure they're investing 4 or 5 months with the founders to coach them, and they put their first money, so they want to make sure that it's actually, if one of them goes through the coach and they leave, it just whatever works, right? I mean,
But otherwise, it's not something
no,
that's...
never the case. I mean,
Well,
you don't see.
it is good to have somebody with a business background, somebody with a technical background, somebody with a marketing background. I often find all technical founders, right? And they have great enthusiasm, very, very smart, wonderful technology, but they have no idea about the market. And I sit there and saying, you got to go, guys, go find a person who is business savvy, right? So.
And Nitin, what do you see?
Yeah, so
how many founders
I
and-
would say I haven't seen a successful founding team that got to a meaningful milestone that was larger than 3. Whether it's equal or not equal, that's for between the founders to figure out. The one criteria as an investor we look at is the distinction between a founder or co-founder versus a founding team member is the equity stake they have. Why does that matter to investors? It's because we're looking at the longevity. So if you have someone who is a key core member of the founding team but only has, let's say, 4% equity in the company, Google comes at them and offers them a job, very likely that they take that because the downside is the 4% in the startup entity versus if they were a 33% shareholder in the company. And now the opportunity cost for taking the job with Google is 33% stock in this company. So I think from an investor's perspective, the only reason cap tables matter to us is what we're trying to figure out from there is who's going to stick through the adverse times. And we often talk about one of the intangible qualities we're looking for in founders is the adversity muscle. Are they going to stand tough when times are tough? And so cap table kind of relates to that. It's kind of the positive side. It's the carrot to the stick, because times will get tough when you're building a company. I mean, you can be extremely lucky and not face an adversity, but you always have to plan for it. And so I would say solo founders are kind of high risk because you're dependent on one person's bias. So ideally, 2 co-founders, maximum 3.
A couple of questions about, from my perspective, is cap table. Cap table, not from a cap table employee or founder per se, but from a cap table number per se. So as a VC, what are the 2 questions? First question is, what is it that you would like to see on a cap table? And the second question is, what is it that would irritate you when you see a cap table?
Well, yeah.
Well, in general, we look for cap tables. I guess the kind of things we don't like, I have seen that are scare us away, is maybe a VC or somebody gave you a seed round, but it is actually a priced round, and that VC has 70% of the company. I've seen that. That makes it very difficult. It's like to manipulate that. You can do it, but it's still very difficult. Any strange conditions about the different rights for different types of investors or employees, things like that. Anything that's strange. What most VCs like us will look for in the A round is that post money, we like to have a meaningful percentage of the company, somewhere between 15 and 25%, or thereabouts. So anything that and the founders have to have a meaningful part of the company as well of post money, because without that they're not going to stay. And so anything that does to the cap table that prevents that is probably makes this difficult.
And, some of the things that I've been asked to clean up when I went through rounds of financing was they hated a lot of warrants. So during the downturn, a lot of angels and early investors were like, oh, we need 50% warrant. So we gave up the warrant, and they wanted us to clean up. That is, have them buy the warrants at the current price. So the other one is ex-founders. Somebody said, 6 founders, right? The problem is, as the process goes through and they leave, they start owning large portion of the company. So if you have ex-founders who own majority of the company, and you have employees who are not, who are there, but they don't have the skin in the game, then that's lopsided. That's a problem. Nitin and Vera, do you wanna-
I mean, I speak from the vantage point of our companies that have gone on to raise rounds from large VCs, and I would say the only thing on the cap table that would stop the deal from happening would be low upside for the founders. And that's a function of just you've given away too much equity in your early rounds, or there's some abnormal terms. I've occasionally seen founders getting too crafty with the cap table. Remember, you're building your company, not trying to innovate the cap table. So let the cap table be as vanilla as it possibly can be. Because sometimes founders get greedy. Oh, I can take 5x voting rights and stuff like. So usually those kind of tricks get taken away when a serious investor gets involved. But other than that, just generally speaking, at seed stage, I believe most VCs are looking for between the founders an ownership of 70% plus, so that you have, and that's excluding the employee incentive pool. So you have enough incentive to stay with the company to make it a big company.
So we usually supplement equity capital. So when the company closes a meaningful round, let's say $5 million, we would like to come and give $1 or $2 million on top of that $5 million. So it's good for entrepreneur because he is diluted only for $5 million. Our loans are actually very, very cheap. It's like about 5% right now, and we take a very, very small portion in warrants. It's good for investors. Investors like to put $5 million and then see $7 million on the bank account. And it's good for the bank because our model at this stage is venture risk. So we're not really taking the risk on the founding team at this time. We're taking the risk on the experienced venture capitalists with whom we have relationship as well. So since they put Series A, it's very rarely that they abandon the company. Usually there'll be Series B, Series C, and if after Series C things don't work out, then we feel it's a lot of time, it's risky, but at that time we already see that things don't work out, so we actually reduce our exposure. But the model is to supplement. It's cheaper cost of capital for everybody. The bank clearly has the space at the cap table, this area, but it's very important for us to have the partnership with the VCs like Shasti Capital to supplement their capital. So at this stage, again, as a regulated bank, we can't take that much risk to actually give loans to pre-funded companies. But post-Series A, we're very comfortable just again because statistics are very good that there will be follow-up rounds. There might be changes, again, in the cap table, in the valuation, with founders, with the market, with the product, everything can change, but actually Series B usually follows if there is Series A.
So I'm Govind Agrawal from Anaxi Digital Runners from India. Do investors put a clear sales target in the term sheet and also a penalty clause in the term sheet if the sales targets are not met? The equity will get increased based on sales target, clearly defined sales targets?
I mean, I can't speak for all investors. I'm sure there's some cash flow investors that may do that, but that's not a standard venture capital type of term.
Equity investment is like,
it's what I'm saying is there could be equity investment that's linked to sales targets, but that's not a typical venture capital model. That could be somebody else, some other kind of alternative investor that's looking to build more.
I would say the only place I've seen is before you raise your fund and you have to, somebody who's committed but they don't know what valuation, they might say, well, we'll see what happens this quarter. If you hit your target, then it makes sense. Otherwise, we have to go with the valuation, lower valuation. But they don't take away equity because you didn't hit your
It can be tranche. Second tranche can be upon certain...
Yeah.
So the tranches can be milestone based on sales.
I've seen it more with emerging markets VCs, where the VCs are just not as confident and don't have so many choices, so they want sometimes to hedge a little bit.
But look, our investments are not to protect the downside. We're looking for heroes, not trying to avoid zeros, right? So we'll take bets that give us a higher upside. But we don't even ask for a liquidity preference, because what liquidity preference am I going to take when I'll have immediately next round investors coming in at higher liquidity preference? So if investors are asking you that, as an entrepreneur, I always look at something in my story did not convince the investor to believe in the upside, and that's why they're looking to protect the downside.
So you have everybody's LinkedIn. Feel free to ask questions, but don't bombard with marketing about what you do. And if we can, so just if you have really very good questions, really authentic questions, feel free to send it to us and we'll reply to you. Thank you.
Thank you.